We had looked at about a 2% growth in agriculture. Obviously, the number has come out just a little bit higher than that. So the increment or the decrement is caused by agriculture. And my sense is that our initial estimate of somewhere around 7.5–8% services growth, that might have come in a little bit lower. I'm not very sure, because the industrial growth numbers, construction numbers seem to have exceeded street estimates, our estimates. So it's obvious that just lower than expectations growth would probably have been driven by the services sector. But these are statistical quirks. I mean, it's very, very difficult to estimate. I mean, 8.6 is completely in line with market expectations. As of now, because I think we are keeping a status quo on our 8.5% growth forecast, because there are two major drivers that will be coming into play in very short order. And the first one is obviously the onset of the monsoons, because this is going to play a very critical role. If we do get anywhere close to a normal monsoon, it's very, very likely that our growth forecast will be revised upwards. The second is the continuing story of the economic recovery and downturn or slower recovery in Europe and the rest of the world. And that's likely to play out in a little while longer. But overall, we believe that given the negatives and the positives of a slower than expected recovery, global recovery, in the developed markets, particularly Europe, I think it will be on the whole beneficial to India. Because of more subdued, moderate commodity price increases and so on, even despite the slower than expected recovery in India's exports to Europe and the rest of the world. So these are the two critical drivers that we need to look forward. Monsoons, rainfall is likely to be a very, very major thing. And obviously a whole range of secondary issues that would follow from these two developments, particularly the way monetary policy tightening is likely to be taken forward. These are the 2 or 3 factors that will impact our growth forecast for the next year, for FY11.
Yeah, I think, this just reinforces that demand, is there, it's underway. The recovery is underway now. I think the next issue that we're going to have to tackle is inflation. So as you know, there in India, we're now into the almost high double digits, and in the emerging market world, inflation is now gathering steam. Vietnam, for example, it's almost doubled over the last 8 months. So I'm not too surprised with those numbers that you just mentioned, and it's pretty much in line with our research and what we were expecting.
You see, manufacturing growth has been put to 16.6%, whereas GDP growth is 8.6%. So manufacturing has been contributing more and more. It was decided that manufacturing now will be getting a lot of benefits from government. When the stimulus packages were given, those were given for manufacturing growth only. And that is why the IIP number which you have been showing since last 6 months, it is showing that the manufacturing growth, etc. are going. And so far as consumer durable is concerned, consumer durable has been growing 30+. From November onward, it is 36%, and March data we had is around 36.5%. So such is the growth going on, and our Prime Minister, when he has assumed second time as the Prime Ministership, first thing he said that he would like to have a growth of 10%, and this 10% growth he would like to continue for 10 years. So looking at that, government is working very fast, and they will be satisfied that as per the government norm, more than 8% growth of 2010-11, and after that 10% growth will be there. And that is why we have been seeing that the government is on the top to help the industries and also create the employment.
My sense is, if you are looking at a 8.5% GDP growth on a real term basis, you could probably see at least 17 to 20% earnings growth with respect to the companies. So my sense is, the external environment won't be that conducive for you to kind of see a substantial re-rating in terms of a PE multiple. But if your earnings continue to grow 15–20%, I think that's where that's the kind of return you would get. I think for the markets to get re-rated in terms of price to earnings, I think it will be difficult if the external environment is bad. Already India trades as a substantial premium to the other emerging markets, which there is a fundamental basis to that. But I do not think that that valuation gap is going to increase. I think that's probably going to remain the way it is. So no, I don't think there will be a substantial re-rating based on what GDP numbers we have seen. Obviously, if the global markets move back, you would see India essentially maintaining that valuation gap or maybe even slightly increasing it. But if the markets continue to do bad, I don't think that you will probably see a huge amount of re-rating. I think you will definitely, but you will definitely continue to grow at 15 to 20% in line with the earnings growth.